check out the stock of the day on our website. Stay for that.
The call is brought to you by Dexus. Investing with Dexus unlocks 4 decades of market-leading experience in infrastructure.
Get started at IG.com.
Welcome back. The stock of the day is FINDI. FND is the ticker code. So it says that it paves the way for a national rollout of what they're calling BC Max Centers, which FINDI says will provide it with a digital and branch-like banking presence. So the initial 76 sites are projected to generate a minimum guaranteed revenue of approximately $3 million over 3 years. So, bit of news out of that small cap. A share price not reacting very favorably to that. So I wonder if there was a bit of disappointment in, maybe the revenue line in there. Not sure. But what I thought we'd do is take a look at this stock from the technicals, because I do know there's a lot of small cap investors that are interested in this one. Michael, What do you make of FINDI?
Look, not one that we've been covering, but obviously there's a huge addressable market where they are, and they've clearly been kicking goals. But yeah, you're right, Nadine. You've got this sort of situation where it, has released some decent news and even down at these cheaper levels. I mean, the share price is half of what it was several months ago. So why isn't it bouncing? Well, I don't know what the market's expecting, but looking at a weekly chart here, look, I guess what I'm trying to show with the blue lines is that the range is tightening up, but my concern is that the slope of that triangle is the wrong way. Instead of sort of pointing upwards and the share price holding up at higher levels, it just seems to be down on the mat near, just under $4. So every time it rallies, it just ends up back at, the high threes again. So I don't find that very bullish, to be honest. If you get a breakout from here, then you follow it. So if it breaks, above the lines, then you could say, well, that's a buy. But I think if I was to get off the fence, I'd say there's probably more than a 50% chance that it'll break lower, below that lower blue line. And if that happens, watch out, it could fall away pretty quickly. So I wouldn't even be holding it. I'd wait to see what it wants to do from here. So
it's a sell for Michael. Gary, I know that you're happy to follow Michael's chart on this one. What do you see?
Yeah, similar to Mike there. I mean, look, the plus is we are seeing that tightening pattern. So as opposed to the loosers and losers, we are seeing that tight pattern sort of setting up there, which is constructive. But I agree with Mike there. It is sort of downward sloping here at the moment. But the thing I don't like about it is the sort of the price action there. If you look deeper in the price action there, you're seeing that each sort of pullback, the volume's kind of up as well. So there has been a fair amount of selling each pullback there. And I think the market cap's about 245 mil. It's only about 75 in revenue. And basically, I think the loss sort of blew out to about 12 million this year. So slightly higher there. So I had a quick look. I saw its expenses are sort of increased more than the revenue line, which is a bit negative. But oftentimes you do see that in those growth names. They can sort of forego profit there, just trying to grow the base there. So it's an interesting one here. I do like the fact that it's tightened up here, but you want to sort of see, I think Mike's bang on too. I mean, today's probably good news for the stock and it's down. I know you said that earlier, Dan, as well, but that's probably not what you want to see as well. So, I'd probably just sort of sit back and watch this one there. But sometimes these past leaders, which it has been, they don't, I think only maybe about a third of them can come back and lead again. So, the odds don't favour the upside here at this stage, but definitely one to watch there. You want to sort of see some volume come in and start breaking some highs there, but it's a watch there for me. I wouldn't be doing anything currently.
Thank you, guys. Michael Gable from Fairmont Equities and Gary Glover from Novus Capital. Stock of the day was Findy, and it's a sell.
The stock of the day was brought to you by IG. Turn volatility into opportunity this US earnings season with extended trading hours on over 110 key US shares. Get started at IG.com.
The Trade is brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au. Introducing a new era for discerning Australian investors. Brought to you by Ausbiz and backed by deep market insight, professional analysis and a proven track record. Our focus is simple: to connect you with exclusive and competitive.
Hi there, and a very warm welcome to the call. Great to have you here with us. Something a little different today, and I'm really pleased about it actually. We've got a hybrid program. So we'll be talking a little bit of Aussie, and we'll be talking about a little US. So we've got quite an interesting stock list coming up with my two expert guests. And I've got exactly the right people to do it with. Mark Moreland is joining us from Value 3. Nice to see you.
Good to see you.
And Mark Gardner from MPC Markets. Nice to see
Good
you
afternoon.
as well. So you said something, I hope you don't mind me saying, in the break, that you guys now offer US equities.
Yeah, for the last 3 months or 4 months or so.
Yeah, how's it been going?
Well, yeah, we find that once the clients are up and running, they gravitate towards it quite strongly. So, but what we found as well, it improves our ASX stock picking because you're sort of taking quality from both markets. So it's not to say one market's necessarily better than the other. There's probably a few more. US is a bit more inherently bullish as a market, so you probably a bit more shorter term opportunities. But instead of having to overpay or pay a premium for tech, you've got a million options in the US, etc. So yeah, just diversifies the choice. Makes my job a lot harder, I've got to say. It's sort of mind-bending sometimes.
Yeah, well, you were saying even just this morning, like last night was quite the night on Wall Street.
I don't think I've ever written a morning report as long as I did this morning, and I missed the GDP and after I'd published it. So yeah, there was a lot on last night. Not surprised that the market's just drifting around because it's a lot to digest.
Yeah. And Mark, when we were chatting in the break, as we do, you're saying you're preaching to the converted. Mark, you've been loving the opportunities in the US for quite some time.
I've been investing in the US for 14 years. So over the years, what's happened is more and more of my capital has gone over there for a good reason, because there's a bit more opportunities. And it depends on at the times. At the moment, the Australian market is very, very expensive for the quality companies I like. So there's nothing really to invest in, whereas there's still plenty of really good opportunities in the States.
What did you make? We're not going to get too far into the results because we do have our stock of the day coming up later on. But I mean, so far so good for US results and tech in particular.
Yeah, no, they've been strong. I think 70% have been higher than what the analysts were expecting. I mean, this analyst thing's a bit of a faux pas.
Yeah, 70% is not a good strike rate. It's usually above 80.
Yeah, but it's even the idea though, the analysts coming up with a figure, and then if the company doesn't get it, that disappoints, and then it gets sold, or on the other hand, it beats them. What it means is the analyst is wrong.
Yeah, well, that's right. I mean, I think they're on top line on revenue. The number's quite low, 65. But earnings per share, I think they're all is well into the 80s. So it's a bit of a weird one. Normally they're just level peg, 80% beat generally overall. The US systems is kind of designed to beat, basically. They're, like I said, they're a bit more inherently bullish and optimistic, I suppose. Whereas, and they have earnings every 3 months, so it's you're not sitting there for half a year waiting for something to come back. So yeah,
we'll probably end up with that as well. But I think it'd be unfortunate personally. Going quarterly, I think, because it takes too much management time. You're spending so much time on doing reporting compared to running the business. But anyway, that's my opinion.
It's a job for AI, I reckon.
Yeah,
yes, true.
And I'm sure AI will come up in some of these conversations. But we will start close to home. So in this first half hour of the program, Ampol, Vulcan Energy, Ipironics, so that's in the smaller end of the market, Emotive, which used to be GUD Holdings, if you recall, and Pexa Group. So let's get to the first stock picked by you. This is Ampol. This is for Jeff, and he's given us some context. And he says, doing this for Mathan from the investment committee. Okay, shout out to Mathan. Does this company have growth potential? Jeff. And I think that's alluding to the fact that Ampol was taken out of the AusBiz fantasy portfolio. So, Mark, I think you were present at that meeting. Mark Gardner.
I was, yes.
Yep. So what is your view on Ampol for Jeff? So
for Jeff, I'm going to say no, because that's why we took it out. And as well, energy's just really in the doldrums. And I think a really keystone part of Trump's policy globally is to make sure energy prices stay low, to keep inflation intact, under control, because he's obviously introducing tariffs. So I don't really see. I mean, one of the bit of shining lights is the convenience store actually started to improve 4.5% in recent times.
Yeah, but I will point to Viva.
Yeah, exactly. So I mean, it's a long-winded thing. Obviously, the government policy sort of causing that. Causing that imbalance and people counterfeiting, etc. But I think over long term, this business is quite a good business. I think they're utilising their real estate very well, because they are petrol stations are real estate businesses. They don't have the actual petrol necessarily, but they're generally having restaurants there. They've got charging stations in place. So I like this long term, but I just don't think there's any rush at the moment. I think it'll probably follow oil prices back up. I think oil prices heading north really, in any sort of long-term trend is probably minimum 6 months away. I think we've got probably a bit of slowing coming globally, and then I think we'll probably, second half of next year we'll start to see a bit more growth. So I put it on the watch list essentially, but I think it's a quality company, and I think they're doing good things for the future. But I don't know whether it'll rally or not anytime soon.
So if you were in it, would you hold it? I
would probably get out before earnings, because you can just see back there, it got smashed on earnings. And that's a little bit of a problem. This is not the kind of company that's going to shoot the lights out and gap open up, 15%. But it can gap open down 15% if it disappoints, and then you're stuck in it for 6 more months. So I would, if you're inclined to be active, I'd be getting out, looking at earnings, and if you want to get back in, get back in. But I think there's probably some better things you can do with the capital in the meantime.
Okay.
And just be cautious. But if you're 2 to 3 year hold, you're happy to hold it.
So. All right. Morgan Stanley's overweight. Ord Minette's a buy. UBS notes that its June quarter report met expectations. Margins offset weaker fuel volumes, helping to grow the convenience retail earnings.
I don't like it at all. I think it's a very mediocre business. There's nothing wrong with it. But if you look at their 10-year return, it's actually been 2.8% average per year, including dividends. So that graph you're looking at there has been pretty well the story, with some ups and downs over. It's gone nowhere over a decade. Really, so I think that's to me, it's basically below inflation. 52 PE on at the moment, which is very, very high. I mean, the earnings are off, but it's just not worth. I wouldn't even consider it.
Yeah, I think it's a pretty different business now than what it was.
Yeah, but even saying that though, that still requires changes and effect and get it all right. I'd be inclined to say that if the new management, it's new management, isn't it?
I think so, yeah.
If they can then actually wring extra profits out of the business, and a few of the things Mark said happen, it could improve. But that to me is a bit of a speculation. So at the moment, I wouldn't put capital at something that's as mediocre as that. So I'd be a seller as well.
Okay, so that is a sell. Off to a great start here. Next on the list is Vulcan Energy, and this is for Sam. And he says, I heard Kai from MPC Markets say the other day Vulcan is a lithium pick. Why? I was hosting that program when that came out. Yeah, I didn't ask the follow-up, so Sam's doing it for me. Why?
Well, it's in lithium technology, or green lithium. I think, look, tip of the hat to Luke Larrative's probably... I've had this on the call in the past, and I still thank the Lord to this day that you went to Luke first on Vulcan, because he is very much all over it from Seneca Capital.
He's been calling this a buy for a very long time.
And just knows more detail than I'll ever know about lithium, to be brutally honest. So I actually went back and had a look at that this morning. But it's not necessarily just a pure lithium mining play. There's technology involved in it, but like gross margins are 96%. German government's backing it, but it's getting priced as a lithium stock, and it's probably more is on that side of the technology with the refining, etc. So I would probably, like I said, I would defer and go back and have a look at what Luke said about it in the past, because he hasn't. Seneca's got an incredibly detailed view on it. I don't go into the weeds this deep on lithium technology, etc. I'd say I think it's a buy, and I think it's probably mispriced as it's sort of more so miscategorised.
Well, it's not profitable yet.
No, it's not. But if it was a tech company, I think it'd probably be. If it was classified as a tech company, it'd be much higher. And I think it's been sort of put in the basket of lithium miners. So, and the technology they've got a massive head start on everyone else. And as I said, they've got 186 million in government grants. And the German government's really behind it, particularly. So, and it operates mainly out of Europe. So yeah, I would say this is sort of spec buy. But yeah, we don't hold a lot of lithium, if at all. It's more client choice at the moment.
Okay. So Vulcan.
Yeah, I think I'd agree with that it's a spec buy, maybe. But I don't know enough about it to be able to have an informed opinion on that either. Lithium. The only one we were involved in with lithium was Min, which I'm not anymore anyway. So I'm out of that. The trouble is, the price has come up lately a little bit. So it's actually going the right way, but I have no idea what the supply-demand dynamics are and being able to forecast whether that will come to fruition. But at the moment, its market cap is about 926 million. Negative earnings about 41 cents a share. So I think their total revenue is only about 10 million, and they've got 3 million in debt as well. So there's nothing there that would make you, or wouldn't make me feel excited about it, unless you really had a lot of knowledge and be able to be confident to say yes, with all these things, it's going to be great. I have no idea. So that's all I can say.
Yeah, hence why I defer to. I'm not going to sit here and pretend to be an expert.
Yep.
Credit where credit's due. The Seneca crew are very.
And by the way, it's done 44% average compound over the last 6 years per year. So as a story and so on, it's done really, really well. If that hasn't converted yet into a fundamental position, but it may.
Yeah. So are we calling that a specky buy?
I'm not
I think we are. Yeah.
I'm just going to pass.
Okay. Okay.
I was just saying that you could say it's specky buy if you thought you knew enough.
Okay. Let's get to Hyperion X. Yeah. So IPX is a ticker code, and this one is for Tom. Mark, I'll start with you on this one. Small end of town.
Yeah, it is small end of town.
I keep saying Mark as if you guys are reading my mind.
No. Which Mark?
Go ahead, Mark Gardner.
Right Mark and left Mark.
Yes.
Yeah.
Sorry, now Hyperion obviously would have benefited from the defence thematic, obviously being really buoyant recently, and it's at a pretty expensive valuation there at the moment. However, they just got a Department of Defence contract. They are based in the US, in Virginia, sort of titanium manufacturing. I think for sort of lack of options in Australia, there's a few stocks that I think are really overcooked in the defence sector. that will probably come back down to earth over earnings, potentially something like Austal, which is a shipbuilder, etc. But this one maybe not. Like I think I would be hard pressed to buy it up here, and as you can see, it's 5-year chart up 7,200%. But their balance sheets is pretty decent. And I think these contracts that are starting to drip feed in, as you saw with the likes of Drone Shield, they're up for 1.1 billion in potential contracts this year. And this is very much the year of, we're looking at a $1 trillion increase in defence spending globally over the next 2 to 3 years. These contracts are going to go somewhere, and these smaller companies have just got to pick up one or two. And we saw Drone Shield went from 60 cents to $4. I mean, I think that's probably overcooked a little bit. But then they've since gotten another couple of contracts. They spent 5 years getting very few contracts, and now it's you can see that snowballing.
The momentum picks up.
So I from a sector standpoint, I'd say this one's got great momentum. Seems to have delivered in the past. It is expensive. I'd say spec buy, but go very light on it because I think those contracts are just going to keep ticking over. But it certainly wouldn't be a large allocation in the portfolio.
Mark, it's saying all the right things. Titanium, defense,
Well, it has a lot in common
US.
with Vulcan Energy from the point of view of what we said. In that, the titanium, they've definitely got the thematic right as far as they're in the right place at the right time, without a doubt. And their titanium resources are in the US as well, which is also way better from being able to potentially capitalise on what US spending is. Their 10-year return's been 56% a year, so it's actually, anyone who speculated on buying this in 2018 when it listed has done really, really well. But their revenue's only 546,000 last year, and they lost 22 million last year. So that's a long way away from my perspective on actually converting their $2 billion market cap into something that's going to be a return for shareholders. So I couldn't deal with it.
Avoid it.
Yeah, and just to compare, I think Drone Shield got 60 million contracts and got to a $3.5 billion market cap. Yeah. So it doesn't mean that this thing can't go another 30%.
No, I'm not saying that. I'm just saying I couldn't buy it though.
Oh no, precisely. It's a bit risky here.
I used to do it. I used to buy things like that a long time ago. I don't anymore.
Then you grow up.
Yeah, when I was younger.
All right. So look, I hope that helps you. Who was that, Tom? So thanks for the question. I know it's come up quite a lot. And just a reminder that this is information only. This was not financial advice for your own personal circumstances, so you do need to take this into consideration. Now, it's a bit of an unknown whether or not we've got the strap and the chart right for this next one, because it used to be GUD Holdings, but now it's changed to Emotive. And this one is for Charlie. Mark Moreland, let's start with you on Emotive. Give us the history.
Well, I had trouble finding it because I looked up GUB, and I've heard of GUB before, not that I've ever, and I couldn't find it anywhere.
Yeah.
So, and of course, they've just changed the ticker symbol.
Yeah.
And you go, why do think companies do that? I mean, usually I would class it as a red flag. Because sometimes when they do that and they change the name, unless there's a good reason or the business is fundamentally changing, often it's to try and bury some history and start again. But anyway, I don't think there's anything like that involved here. But this is auto parts, accessories, and they do everything to do with auto parts around. And the 10-year return's 4.9% a year, so about 5%. The current PE is about 15, so it's not expensive. Its growth has been very poor over the time. I think this is a pretty ordinary company. I had a quick look at it against ARB, which is they compete with in a lot of areas, and ARB's done about 12% compound, which is not that fantastic either, but it's a lot better than these guys. So I would be a pass on this one.
Okay, that's a pass. What do you think, Mark?
I'm probably a little bit more positive, but more so from a dividend perspective. We're obviously coming into an earnings season in Australia. We're traditionally a bit of a dividend-hungry investing market, and the mining companies are sort of, despite being quite cheap, it's still, there hasn't been any major uplift in commodity prices or so we're not going to get any huge dividends there. The banks are just eye-wateringly priced, so you're not going to get any dividends there, and everyone's calling rates lower. So, if you were really hunting for dividends, I think this is 4% on fully franked. I don't think you'll get into much trouble with it. And if they do, I think mean, it's fairly well managed. It's fairly financially sound. It's pretty beige, and that's maybe if you're hunting for the dividend and you just don't want things to go wrong. It's probably, but I wouldn't be buying it for growth. I'd be more so buying it more on its reliability. And I think we spoke on the CRB yesterday. Investors will be, if they've sold out of CBA or BHP, it's probably not going to, or Fortescue aren't going to provide the divvies this earnings season. People are going to start looking around, and anything over 4 is not too bad, but you just don't want to. You don't want to fall into a trap where you're getting a 4 or a 5% fully franked dividend and then the stock gets hammered because it's not performing. So this would be one of those ones where, I'm not expecting it to shoot the lights out. It'd be a hold probably. But if you're hunting around for dividend, that probably would be what attracts you to it.
Thank you. Let's get on to the next Aussie stock before we shift gears for the next half of the program. And this is PEXA Group. This is for Cooper. PEXA just had, and I'm going by memory here, apologies, I was at a meeting before this. PEXA just got a deal done in the UK in some way, shape, or form, and it did give it a bit of a boost. NatWest has appointed PEXA to set its path to digital property transaction. That was just 2 days ago. I knew it. Look at that share price appreciation there off the back of that. So, Mark Moreland from Value 3, is this now a bit expensive, or is this sort of momentum that you want to hop on?
It's not a company I know. I had a look at it. They do electronic conveyancing and so on.
Yeah, and they've got the market cornered here.
Yeah, and it should be. Well, if they've got the market cornered here, why have they done so poorly? Because that's what I always ask when you look at these companies. And the 10-year returns have been an average of 1.6% a year, which is woeful. Now, that may change now, but you're talking about changing a 10-year history in an area where if they were effective in operating their business and their product was good, they should be doing really well. Because this is a massive area of opportunity of changing out from a disruption point of view. In other words, going from paper-based systems to electronic. It should be a sexy area, but they haven't shown any sign of being able to make that work. 2.3 billion market cap and their earnings per share are negative 26 cents. So the UK contract might be meaningful, I don't know. But I wouldn't be looking at it. It's not worthy of further inspection.
Gosh, this is another pass for PEXA. What do you think?
I don't mind it. And look, it's got a stranglehold, and I think it's kind of sacrificed profitability to get that stranglehold, like to the point where the ACCC investigated them, and I think they're through that now. And UK market's very similar. So NatWest won't be the only one they end up getting in the long run. I think it might be a bit of a juncture or fork in the road where maybe kind of, I don't know, like Xero was, where they, instead of just growth at all costs model that they had 2 or 3 years ago, they sort of switched to starting to bank. They've got dominant market position, starting to actually pull those profits in because they've got, I think margins over 56%, 90% market share in Australia. I mean, I think they probably just need to grow up a little bit potentially. And I said the same thing about Xero a few years ago, and start to return something to the shareholders and start getting that EPS, in the positive territory, and maybe it doesn't have to be dividends necessarily. But you can't just be exponential growth forever, and I can't see this software. UK and Australia are very similar. I don't know how applicable this would be anywhere else in the world necessarily, like Xero.
They said it was mainly the Torrens title. Yeah, which I read in one of the reports.
Yeah, I mean, it's kind of one of those. It's just an unavoidable thing. You have to use it these days. But you've done well. You captured that market. I think you just start to. I would want the company to start banking some net profits now. And if it didn't, I wouldn't go near because I guess companies or managements can get addicted to trying to the next big thing, and at the end of the day, the idea is to make money, right? So, if they start to show signs of that, I'd be happy to be a buyer. But at the moment, I just want to send them back off that growth a little bit and start being a bit more fiscally responsible.
So if you're in it, hold it.
Yeah, I think if you're in it, you're bought into the story, etc. But and like Xero shareholders did a few years ago, they had a clean out, and then the new management came in. They adopted a new business model. And look at the share price has more than doubled. So it's not necessarily going to be bad for the share price to start pulling back and being a bit conservative. You can't be a Peter Pan company and stay young forever. At some stage, it's okay to consolidate.
All right, so that brings us to the halfway mark. Ampol, it's a sell for both of my guests. Vulcan, it's a specky buy for Mark, but it's a pass for Mark. MPC Mark, it's a pass for value 3 Mark. Hyperion X, it's an avoid for value 3 Mark. It's a specky buy for MPC Mark. Emotive, it's a pass for value 3 Mark. It's a hold for MPC Mark. And PEXA, you just heard what the guys had to say, a pass. I'm letting you get away with a lot of these this afternoon, Mark, but it's a pass for him and it's a hold at best for MPC Mark. Okay, the investment committee, guess what? We're bringing you a new edition on Monday. The committee meets today. So far, so good. The fund, the fantasy portfolio, up by close to 44% since its inception at the beginning of March 2022. So stay with us. We'll get you across more companies to come, but get your requests in. If you want the investment committee to consider something, it still needs to pass the filters here. So ausbiz.co/call picks if you'd like us to answer a question for you. And we'd love it if you give us a bit of context as well, but totally up to you. All right, so now let's get to the US, should we? Amer Sports, On Semi, IBM, Hims and Hers Health, and Alphabet. Very timely. So let's start this with Amer Sports. And this one is for Andy. And I think that Andy has asked about this one a couple of times. Andy, my apologies. I can't remember if you own this one or not. But let's take a look at that chart. That is very impressive over the past year. Mark Moreland, can it continue?
Yeah. Well, I do really like this company. It's an excellent business. Often, sometimes when you're used to brands that you buy, when you see who has those brands, it's a good way of looking at companies on how good they are. But anyway, one of their biggest product is Arc'teryx, which is a very expensive sports stuff, if you like. I love their stuff, it's just fantastic, but it's super expensive, and you can go to Bondi Junction, they've got a shop there, and you can pay $120 for a t-shirt, because that's how much they are, just for a t-shirt. And if you want to get any of their, they call it technical stuff, but it really is good. So you get a raincoat, $600.
Yeah.
And things like that. And so I buy it selectively, because it's just so nosebleed expensive. Anything that I'm going to use long term, then I'll buy that sort of product, because it's just brilliant. Anyway, that's very profitable for them, as you'd expect. So they get 28% of their business in that, 664 million, and this is largely Asia Pacific, China, and then their direct channel, which is about 40% of the business. So it's even though it's a US listed company, it's more in our area, if you like. Financial health is excellent, and the net debt's about 1.1 billion, and it was $13 a year ago. It's now 37. You saw that on the chart. So it hasn't been listed very long. Short history, only a year and a half. It's a PE of 100 though, which is a bit scary.
That's not very value.
no. Scary for ASX. It's not uncommon in the US.
No, I know. That's the only negative I'd have about it, but I think it's a great company, and it's something I would be quite happy to have in a portfolio if you have companies like JB Hi-Fi and others like that. This is in that sort of category, but arguably it's a better business from the point of view. It's a big statement, but JB Hi-Fi is on a 26 PE, which I think is nosebleed for them.
So is this a buy?
No, I couldn't buy it. I haven't done a deep dive on it. All I did was have a look at it all, read the highlights and so on, and it all looked great except for the 100 PE. So I would say, and it's just had a big run up, remember?
Yeah.
So there'd be a good chance to buy it. When next time we have a market downturn, I'd say it's a buy at a reasonable price, but I can't tell you what that price is at the moment because I'd have to do the work.
Well, watch the space. It's a hold for now. If you're in it, you're lucky to be there. Yeah.
I did a little bit of work on it overall. I sort of came to the more work I did on it, the more I started comparing it to Lululemon because it's just super high premium and high margin.
Good money compared to.
And that was where the point, because it is 100 PE, hyper growth. I mean, their net profit margin is razor thin, despite the fact they charge $600 for a jacket. But I do like the fact that it's Asia Pacific, so it's kind of tariff immune as well.
Yep.
And they do have there's a few brands. I hadn't heard of many of them, but if you're charging like those super premium prices, maybe I'm just too used to going to Kmart because I've got too many kids. I think this is a long-term winner, but I think it's too expensive at the moment. I'd be selling this at the moment because it's Lululemon was a great story and it went ballistic to the upside, but this is half of Lululemon's market cap now, just about, and nowhere near the metrics. So I think this will probably pull back, and as you can see, how quickly this has rallied.
So you'd take some profits.
I'd sell it, and I'd be looking to buy maybe 30% lower. Depends on what the broader market does. Yeah. But coming into this is seasonally not a great quarter generally for global equity markets. This is the prime candidate of the sort of thing you want to be taking profit on if you've got it for sure. But make sure you put an alert in and buy back in, because this thing will probably be at $70 in 2 years' time.
Got it. All right, so let's get to the next on the list. This is on semi. Mark, I'll start with you on this one because at our Going Global virtual investor event last week, this one came up in conversation.
Yes,
so,
we mentioned it. We didn't say anything about it.
Yeah. Okay. So let's delve a little deeper.
Okay. This is a company that supplies NVIDIA, or is fundamental within NVIDIA racks, and also Tesla as well. And they do a lot of what they do is the vision-based cameras, but all the electronics behind that. There's a lot in that. It's not a camera. You wouldn't class them as a camera business. It's a semiconductor business. They actually have their own semiconductors that they make, and they've been around for quite a while. Their return over 10 years has been 20% a year average, which means you've got 51,000 on your 10,000 investment. So it's done very well. It's gone through a bit of a lull recently in their performance, but the business has very much shifted from being, let's call it analog, because they provide a lot of electronics on voltage control and so on for the automotive industry and other industry at large. And now they're progressively getting more and more benefit of being in prime position for AI. So this is one of those companies that is going to benefiting from Blackwell rollout with NVIDIA. So they've got lots of bits in there of theirs. So every server NVIDIA sells on semi get money. Because Tesla, they do the cameras for the cars and so on, and they'll be doing robotics as well. So they're going to be the market leaders in a lot of this stuff. They've got some very, very good technology, so I really like it. So I bought it in April. It was $35 in April. So it's now $58. I wish I'd put more in, but I put a reasonable amount. So I'm taking a long-term view on it. I think they are quality business. I thought it was cheap in April. I think it's still a buy. I'd call it a buy now. And it's on a PE of 38, trailing in 20 forward. And price to sales 3.6, so it's not expensive. Okay. And it's got very, very well positioned, and people don't know about it. I think it's one of those companies that's very much under the radar.
Yeah, it is.
And these are the sorts of companies where you can pick them up for good prices and just add to the position, build it over time. I think they do really well.
Well, it's because the story's about NVIDIA and Tesla. It's not about on semiconductors. Even NVIDIA, it was the Bitcoin miners that worked out that their GPUs were super efficient, and then that made it so. It's lucky they had Jensen at the helm and he pivoted. But I mean that company never started out trying to be an AI dominator.
Gaming company.
Yeah, exactly. Yeah. And look, and I think Tesla's extraordinarily cheap. I think that robotics thing and the sensors and the power. I mean, if you're paying $150,000 for a chipset, I mean, peanuts what you're paying for these things for the power and sensing to monitor these systems, because if it blows up or if there's an overheat or whatever, it's an expensive fix, and you're on a 3 to 5 month waiting list to get it again. So I think that's why this is undervalued. Is that it's the companies they're selling to are the story. It's not necessarily them, but and the cameras for the. I think I'm really positive on Tesla as much as it's been beaten up recently, but the total addressable market of the robotics and the robo-taxis will trillions. It will make the automotive section that they've got now just be a side project. And one of the interesting things I saw as well with Tesla was that these robotics, it's all reliant on sensors, but once one robot makes a mistake, it learns a lesson. It filters out to everything. But if they want to re-gear an entire production line, the robots will be able to do that, and you can pivot your manufacturing to chase higher margin products, etc. So, they will need these cameras big time, and automated driving, you will need them. Monitoring, you're expensive. So, this is a massive buy for me. Great work at buying at 35, but I have no hesitation buying at 58.
No, that's what I'm saying.
So,
I'd buy more. By the way, talking about Tesla, I bought more Tesla yesterday.
Yeah,
it's already my second biggest position, so there you go.
It's really divisive, and people really either love it or hate it. But the haters are going to be sorry in a couple of years, I think. Yeah, but it's all about future. Yeah. So, I mean, you're banking on Elon pulling it off, but oh my lord, if he does!
Look at his track record. Okay.
All right, let's move on from that. Let's get to the next on the list.
Tesla, I think.
Yeah,
I hate to get involved.
The next one, old school. You know, it's funny when you think of the likes of IBM as being an old school tech company.
Well, yeah, and quite a few of the old school tech companies like Oracle making a massive comeback recently. So, it's sort of retro in a way, but unfortunately they disappointed at the recent earnings. And look, I think you want to. I certainly didn't. I didn't like it at the higher prices. I've been a bit more inclined to buy it here now. But as you can see, beautiful chart there. Really, if it was a technical episode, I know what both people would be saying. It's trended up really nicely. I think there's better options in the space at the moment, as seen by Meta and Microsoft this morning. And I'd be happy to buy this when it was a bit more unloved, to be honest. I think it's been, I think the earnings was a bit of a shock. It was riding I think the fact that what was old was new again, and Oracle, etc., that IBM rode the coattails. But they do have some pretty impressive, I mean, Deep Blue was like the original AI. And they do have some cloud, high-end cloud stuff going on as well. But yeah, I think there's better options in the space at the moment, but they could have an AI breakthrough because they've been doing this longer than anyone really from a technology standpoint, which could see this thing sort of shoot up. So it'd be sort of the one where maybe wait, keep an eye on it, keep it on a watch list, stay up to date with it, because I would say they would have the most amount of AI training experience of any company in the world. Okay. It's certainly one that I'll keep on watch list, but not a buy at the moment.
No. Okay, so watch list material. What about you, Mark? IBM?
I totally agree with what Mark said. I think this is a major. It used to be you didn't get fired for buying IBM, but you'd be surprised to know that they've still got massive number of mainframe computers in banks around the world. Now, at some point in time, they have to get changed out, but a lot of these computers are 20 years old or more. So there's a challenge in being able to get people who can actually code for them, because they're all running, I don't know what they're creating in banks, it's still C or something, whatever it is, but it's a long way away from...
Can't AI just create that code? Can't AI just create that code?
But the trouble is you've got this complex, it's the endowment of what you have in the legacy system is the problem. Okay. You try and change anything. Anytime you change things, they'll all sweat bullets. What can it do? Anyway,
and you don't want to play Jenga with the banking system.
No, exactly. So it's a horrible job. Anyway, they spend $7 billion on R&D. So they are the largest industrial research organisation apparently in the world.
Oh, really?
Still, yep. And they've got 160,000 consultants who work in global industry and companies. They've got a massive sales force and consulting force. So they still have some very, very big assets is the point. They've got 62 billion revenue. They've got 13 billion in free cash flow. So all that's good, and they are trying to reinvent themselves as an AI hybrid cloud solution is really what they're trying to do. But the growth's been really modest at about 1.4% a year. So I totally agree with Mark. I think this is a company that's trying to get back in the game again. It's got lots of assets. There's no reason why they can't. They've also got they're right up with the leaders on quantum. You know, with their they've got one of the functioning quantum chips and so on. So that's a blue sky, a blue ocean, if you like, that one. But you can't value it at this stage.
Well, it's got to work first.
Yeah. It's got to work first. That's right. So the legacy business is in decline. They've got a lot of transformation risks. It's got very strong moats. 10-year returns been 8.3% a year, which is okay, but it's just market. So I agree with Mark. I think it's one that I'll put on our watch list and we'll follow it. But I'm nowhere near buying it.
Got it. Thank
Better
you, guys. IBM. Let's get to Hims and Hers Health. HIMS is the ticker code. Now, a lot of Aussie investors might not have heard of this one, Mark. Is that to their detriment?
Well, no. It's early days. This is I'm a shareholder.
It's digital healthcare company.
I'm a shareholder in this as well. I've been for about over a year.
Mm-hmm.
I like it. I think they're building a platform business. They're working in basically class as telehealth. So you do it all via web virtually and see the doctor and so on. They're currently doing 10,000 visits a day. So and then they're providing a combination of compounded drugs, which they just they're having a big fight with Novo Nordisk at the moment on semaglutide, which is par for the course, by the way. Hims took a hit on that when that first was announced, but I think it's part of their business model. But if you look at the business, they've got, I think now 2.9 million regular users who are on subscription plans. And this is all within 5 years. It only started 5 years ago. They've done 48% per year return at the moment. So you're up 6x already in 5 years. So it's doing really, really well. Their latest report they came out with and so on I think it's fantastic. So I think this is a fantastic business. And I think it's early days, on what its potential is. It's currently about a 6.5 billion market cap. But at the moment, they're the leading telehealth provider in the US, but they're run by a strong founder who's really using what we talked about before, which is the Costco algorithm, totally focused on drastically disintermediating the market, reducing costs and sharing that with consumers. Example quickly is their semaglutide competing with Wegovy in the US. Wegovy is $1,100 a month and theirs is $200. Obviously the big pharmaceuticals are going to try and run them out of business because that's what of course they will.
Yeah. Why wouldn't they? All right, so this is a buy?
Yes.
Mark?
Yeah,
Mark Gardner?
We're holders of this as well. And it was talked about in the office for a couple of months, and then someone actually heard you talk about it, Mark. One of our clients.
Happy to help, Mark.
But we've been umming and ahhing because the valuations, because it's grown so fast, and then it had that really savage pullback there in January, February, and sort of didn't want to take on something that was as volatile as this at the time. But I've done more and more work on it over time, and we wrecked it, I don't know, probably a couple of months ago. I think Novo Nordisk got smashed the other night on the GLP-1 drug weakness. This is already that's already been factored into this one. But from a growth company point of view, revenue growth rate last 3 years has been it's been 111% and then 70%. Their recurring income is fantastic as well. Total addressable market's at least 100 billion, and I think that's just US alone. And they're a $6.5 billion market cap. And they've got the massive advantage that telehealth, it's expensive to go to the doctor in the US. So by way of it being expensive to go to the doctor, you've almost got a marketing plan by default pushing people to this platform as well.
They do. They don't charge for the consult. As long as you buy your prescriptions through them, you don't pay for the consult. How's that for a differentiator?
Which, obviously we will be a lead loss, sort of strategy, but if it gets people on the platform, it doesn't. There was talk of them going into Canada, which I question that different health system, a fair bit more free there. But look, I think this has got a lot of upside in it. I don't think you need to go nuts at it necessarily, but I definitely would buy it today. I think you can add on weakness as well. And with the drug companies just at the moment getting very beaten up, I think this is a really good way to and this might provide more pain. And
Well, Trump's given the whole industry 60 days to reduce all their prices. He wants US to be paying no more than the cheapest in the world.
And who knows? Like Trump might turn around and start championing this company because it's bringing down drug prices.
It's a US company.
What's that? Sorry.
And it's a US.
Yeah, it's a US company.
No, they're Nordics, Danish.
Well, yeah. I mean, who knows what he's going to say tomorrow and then change his mind. But yeah, and really high efficiency, profitability leverage. So yeah, a big buy from us. Yeah, and I just add to it over time, to be honest.
Okay, there we go. HIMS, if you haven't heard of it, you have now. Let's get to number 10 on the list, and this is Alphabet. This is Google for laws.
Very interesting company.
Really interesting company. So I was at a gathering the other day talking about relative valuations, and Alphabet looking pretty good value to this investor. You, Mark?
Yeah, absolutely. It's about, I think it's on 19 P.
17
last
times.
time. It's a 19 or something like that. It's a low valuation based on its growth rate. Look, I think comparatively out of the FANG stocks, and by the way, I think all the FANG stocks are good. There's some cheaper than others, and Google's right at the bottom, I think. Is that right?
Yeah,
I think it is. Right. It's pretty close to it, if not the bottom one. And I think part of that is because the perception that AI and large language models searches are going to kill the Google's business, when 90% of their revenue is coming from advertising. But what people forget is Google are a major player in this space as well. I mean, they've got their own AIs, and I just looked at a few stats on it. And they not only is the advertising revenue still going up, so on their latest report it was up 9.8% year over year. So there has been no perceptive impact on their revenue from AI. Personally, I don't use Google anymore. I just use Perplexity or so I look at it and go, well, I'm not using it anymore, so they're not getting any advertising revenue out of my eyeballs. But overall, and they're a global market, don't forget. So it's the whole world. But also, if you look at the rest of their business, they've got their AI now. Their AI, they've got 1.5 billion users per month now, and on their AI, and they've got their overviews reach 2 billion monthly users over 200 countries. So they're a major player with Gemini, and Gemini I think is a leader in the at the moment over the large language models for graphics and for film and so on. So the cloud business is growing really well. It grew 32% last year, which is 85 billion, up 10 billion in February, and their market cap is 2.3 trillion. So they're about, I think they're number 5 on the largest companies. 10-year returns been 21.6 average per year, which is 6x on the last 10 years. I suspect that'll continue. I was taking a bit of a negative view on Google about losing on advertising, but I think they are absolutely aware of it, and they're the kind of company now that I think they'll allow the cannibalisation of existing businesses to make sure they're a major player in the new areas. They're not going to sit back like Kodak did and said, we won't go into digital cameras and we'll try and squash them to keep our film business going. They aren't doing that.
Yeah.
So I think Google's priced well. That's you can't get this kind of earning rate in Australia at that sort of PE. Let's put it that way.
So it's a buy.
Yeah.
Google.
Yeah. Look, I think I agree with valuation. It is pretty cheap. I think the numbers are very generous, and I think they disingenuously use a lot of their search engine volume for their Gemini usage. They have continually buggered up a lot of launches on AI, and I don't think Gemini. I mean, there's a lot of leapfrogging in that, but they're not the leader in any metric at the moment. But look, next week it could be different. Grok obviously released 2 weeks ago is benchmarked well above, but this is what happens with this sort of technology, is that it'll be a constant leapfrogging all the time. Google's due, I've got to say, because they do have a really rich history of being innovative, and I'm pretty surprised, and the amount of data they have as well, and they digitised data 15 years ago. So I'm a bit surprised. I want to buy this because I've obviously grown up on Google platforms, etc. We use it all the time in the office, but we use multiple AIs for different reasons, and Gemini not generally one of them. But like I said, that may change as well. But until they come out with something that's cool, I think I'd rather have my money in some of the others. I quite like what Meta's doing with open source and things like that, and the way they're using their data, etc. But yeah, I don't think the numbers are as rosy overall. But again, this thing's moving so fast. We've been using some of the AI platforms in the past, and then we come back 6 months later.
6 months, 6 weeks.
Well, and everything's changed. Business models changed. Features have changed.
So Google, what's the verdict, Mark? Buy, hold, or sell?
I mean, hold it if you've got it, because it is cheap. But it's not a buy for me at this point until they show a little bit more.
For the record, I don't own it, and I'm not buying it.
Okay.
So because I think there's better choices too.
Yeah. Okay.
It's good.
Well, that is the US half of the program. Amer, a sports company perhaps many haven't heard of. This is for Andy. It is a hold for Mark only because of the massive PE. It's an excellent business, long-term winner, but Mark would be taking some profits, actually crystallizing profits if you've made them so far. Wait to get in at a better price. On Semi, it's a buy. It's not expensive, says value 3 Mark, massive buy for MPC markets. IBM, watch list material for both of my guests. It has form, let's say that, and it's still spending big on R&D. Never discount IBM. Let's get to hims and hers. It's a buy for both of my guests. Google, a buy for Mark, value 3 on valuation grounds, but a hold for Mark Gardner, and I think you should take note, Mark hasn't been buying it himself, so take that into consideration. That is the program. Don't forget, our stock of the day comes up next. Thank you to my guests, Mark Moreland, Value 3, Mark Gardner, MPC Market. Thank you for writing in and requesting those stocks. And thank you for those of you who have become an AusBiz supporter, allowing us to continue bringing this program each and every day of the week. Stay with us for our stock of the day. Struck again, robust guidance. It's lifted its price target off the back of this result. Eye-popping cloud and AI strength, according to the analysts there, with strong guidance to start FY26. It reckons it's in the $4 trillion market cap club. Mark Gardner from MPC Markets and Mark Moreland from Value 3 are here with me to give you their view on Microsoft. So is Microsoft emerging? Not just as a cloud winner, clearly we know that, but as an AI force to be reckoned with?
Definitely. I think what Satya did with, he committed very, very early in buying up all the NVIDIA terminals. And big. He went big, fast, whereas a lot of the others were caught holding, sucking their thumbs. And then, of course, they did, we need to do this too. And then they go, sorry, I bought them all. So now what he's done is they're now converting that into revenue. So they've got a real march on the market. I mean, the other cloud providers are doing well as well, but Microsoft really has jumped up. I think it's under the new management. Before it was became super woke. I think that's slowly reversing. And when I say woke, I mean my son-in-law worked there. He was a senior engineer. He ended up leaving. He couldn't stand it because it was all focused about what you say, what you don't. Nothing about the business. It was really crazy. I looked at it in those days and recommended he sold all his shares, which he did, which with hindsight now was bad advice.
Okay.
Because even these big companies that have got such momentum, often they can do all sorts of stupid stuff and so on, and it doesn't make any difference because the amount of revenue that's coming in from all the Microsoft products and industry and so on is an incredible cash flow machine. The business is doing really, really well. I think, what else can I tell you? From a risk point of view, one of the big things that's coming out which might affect them is their OpenAI deal, because they went in heavily with OpenAI, which they saw as giving them a really strong strategic advantage in the LLMs against the others. Now that OpenAI, Sam Altman's shifting to a public benefit corp, which is like a non-profit, after Musk was suing him. Anyway, long story, but bottom line is it triggers that Microsoft will go from 20% equity in OpenAI to 49%. But there's a clause in there that says as soon as OpenAI gets to AGI, general intelligence, it strips out Microsoft's ability to access the results for anything. So in other words, they're going to own 49% of this thing, and as soon as it gets to AGI, we're now thinking that's sooner than we thought. So who knows how long, but it might be a year, 2 years, 5, whatever it is, and then Microsoft won't be able to use it. So there's a big bun fight potentially happening there. So that's a bit of a cloud on Microsoft. They've got rid of 15,000 jobs, and then they set another 2,000 for underperformers. So you assume 15,000 they decided to be replaced by AI, and 2,000 underperformers, which would be a regular thing for them. And they stood up 2 gigawatts of new data centres in the last 12 months. 2 gigawatts power. That is massive in the last 12 months. And Copilot's now got, which is their AI product, has over 100 million active paying monthly users. So they're going very, very well, and it's a money machine.
Okay, so that's a buy?
I'd say it's a buy on. I wouldn't buy it now because it's just had a big run up, but I think you could absolutely add to it on whenever it gets weak. You could build a position in it.
Buy on weakness, Mark.
Yeah, further to Mark's point, like that. Yeah, it's sort of coming out of being a bit of a snoozing dinosaur for a while, and I think yesterday in the CRB I said it's really, based on the last sort of 5 or 6 years, it was sitting at an expensive PE, and they just smashed it. And I was a little bit concerned leading in, but the 75 billion for Azure, that's the first time they've actually quoted that number as in their reporting as a singular. So, and they reckon there's going to be 37% growth next quarter. Yeah. And and you go back and look, there was a bit of when they did go really hard really early. I think Sam Altman's going to end up being a footnote in AI in a few years' time. I don't think that Microsoft's been around a long time and they're very savvy. There's no way that's a mistake that they would have about 4 or 5 dogs in this race. Yeah. But Sam Altman was lucky enough to be disingenuous that it was open source and then go and sell it to Microsoft. But it was first mover's advantage. That's all Microsoft has paid for. And I think they would have broader plans to hedge against that, because Microsoft doesn't do a deal like that and pay through the nose to then lose it when it hits an AGI point. So I'd say spec buy at the moment, just with momentum, because I like Microsoft's back sort of vibe, because I've sort of changed my view having a look at it. The new management has made all the right moves. They went, and it was pretty risky to go as hard as they did, as early as they did, and it's just paying off beautifully now. So I think this is a bit of a new Microsoft. I mean,
it's got its mojo back.
It's got it, yeah. That's probably the best way to put it. So I would obviously, you'd like to buy it cheaper, but I think you probably need to move up where the PE range has been, or forward PE ranges have been for the last 5 years. I think you just need to adjust that up now, because I don't think it's going to be cheap anymore.
Earnings are going up.
Well,
he actually said though that they could actually increase it a lot faster if they could get the compute, which they can't. So in other words, they're still saying the market demands are far greater than what they can deliver, and they're spending big on quantum as well. So there was a side announcement after that, after the earnings today. But it's super impressive, and I think they're 80% of Fortune 500 are all on Azure AI Foundry. So that, like Microsoft 365 or Microsoft Office,
business model base that just ties people in and locks them in forever. They've done that first mover's advantage. They've done that to 80% of the Fortune 500.
Yeah.
So earnings are not dropping off anytime soon.
No.
So
Interesting little fact I found out on that is that if you look at all the big companies, they actually don't have all their eggs in one basket. They deliberately. So Microsoft has 80%, but of those 80%, all of them probably have a certain amount of either Google Cloud or whatever. So they hedge their bets. They don't put it all in one, but they're absolutely dominating because of their position at the moment.
Okay, so it's a specky buy from MPC Markets and a buy on weakness from Value 3. That's the stock of the day, being Microsoft.
Okay.
The stock of the day was brought to you by IG. Turn volatility into opportunity this US earnings season with extended trading hours on over 110 key US shares. Get started at IG.com.
Well, I want to get you across some of these broker moves coming in thick and fast this morning.
Well, let's go straight to the boards and see how we're opening.
Big moves in the Aussie dollar overnight, now starting to flow through to equities.
The Open is brought to you by CCG. Tired of market volatility? Our investors earn 9 to 10% per annum. Fixed income backed by real estate. Secured lending. Smart investing.
The call is brought to you by Dexus. Investing with Dexus unlocks 4 decades of market-leading experience in infrastructure and real estate. Unlock the potential of real assets to deliver value today and long into tomorrow. Unlock potential and create tomorrow with Dexus.
Good afternoon. A very warm welcome to the call on this Friday afternoon. It is a Friday, and we are going to put the focus on small caps. And I've lined up 2 amazing expert guests to do that for us. A familiar face, Luke Winchester from Merriweather Capital, and another familiar face, Ben Richards, joining us from Seneca Financial Solution. Gentlemen, good afternoon to you. Look, Ben, we've been hearing from a lot of small companies, these quarterlies coming out, of course, ahead of official results. What do you make of what we've heard from some of these small caps?
Yeah, g'day Nadine and Luke. Always good to be here on a Friday afternoon. Lots happening in the markets between quarterlies and trading updates and coming into reporting season now in August. So plenty to keep Luke and myself busy on the desk here, and I think on the whole, trading updates have been quite well received, particularly in some of these micro cap and small cap companies. We'll talk about a couple today that have kind of been below the radar of investors, haven't quite had the sexy headline appeal of some of the larger more well-known names. And now they're starting to kind of deliver on the last 12, 18 months of just business execution and putting some good results in front of investors in the market and getting good traction for that. So it's good to see. It's kind of a good tailwind for small companies, we think, particularly in potentially a falling rates and a bit more liquidity coming back into markets. So yeah, plenty to look at and lots of opportunities, we think.
Yeah, I was going to mention that inflation read. We will have interest rate cuts, I should say, coming probably as soon as August. But Luke, look, Ben referenced some of those headline-grabbing, high-flying names. If you take something like defense, it's been such a hot sector. We had an update coming from Drone Shield just this week. Is it a bit, tired? Hyperion X was on the call yesterday. Would you be avoiding some of those real high flyers right now or taking some profits?
Oh, it's often not a bad idea to take profits in a hot thematic like defence, Nadine. I mean, we had I think it was Amero last time I was on as well, 3DA. As you said, there's a few in that defence space, and there's always a kernel of truth when you have these thematics. I mean, be it 3D printing, cannabis stocks, crypto, lithium, there's usually some sort of either macroeconomic or just general tailwind behind the sector, and it's the case here with defence. I mean, you've got the US and in particular European governments really committing to higher GDP spend. Now, the thing you've got to be careful of as an investor is how you play that thematic if you choose to do it. I mean, often big swathes of money like that finds its way to the more established, larger players. Some crumbs fall down to the smaller guys. You just have to be careful of the prices you pay. So, always focusing on that business. And some of them are doing okay. They're announcing contracts. They're growing quite strongly. It's just got to be careful you don't get swept up in the euphoria of a thematic. So always just, paying attention. If you've had a good run, never be afraid to take some off and look to reinvest.
All right, well, let's see if we've got any of those scenarios coming up in this first half hour of the program. Just a reminder, our stock of the day will be at the end of this program. If you are listening or watching on demand, you can find it online at ausbiz.com.au, and it's a good one today, a company out with the trading update and in keeping with our small cap theme. So let's just tell you what we're going to be talking about. PEXA Group, XRF Scientific is coming up, Red Hill Minerals, AIC Mines, and Vizarn. So that's one that I know that Luke is familiar with. Let's dive into PEXA. And this is an interesting one. It came up yesterday. So my guests at the time, Luke, said that perhaps PEXA needs to grow up. That was a quote. Stop just looking for growth and maybe start thinking about shareholders as well. What do you think?
We've got a few names on the list today, Nadine, that Ben and I have discussed in the past, and it's always interesting. A few months have gone past. It's good to. I went back and had a look at what we said back then. PEXA was one of these names, and yes, I saw it come up yesterday as well. Some interesting comments. Look, my view back then. I know Ben owns this one as well, so I'm sure he'll have a bit more detail in the actual business. My view is you've got a very dominant Australian monopoly, and you see that in the segment reporting of the Australian business. It's more than 50% EBITDA margins, exactly what you'd expect to see, similar to like an ASX or something like that when you've just got that sheer monopoly in a space. And the criticism of PEXA, outlined this a few months ago as well, was management sort of taking the earnings from that golden goose in Australia and looking to grow in the overseas, particularly in the UK, sort of have an emerging digital solutions segment as well, which is washing its face. But the criticism that was outlined yesterday, I think, was a fair one in the sense of the dilution of that wonderful Australian business. I still said it was a buy at the time. I know Ben did as well. For me, I thought all you need in this business was some fiscal discipline. Now, a new CEO has come in already. He's sort of intimated the market you're going to see that kitchen sinking, that clearing of the decks. They've called out tens of millions of dollars in potential impairments, write down something like that. So he's going to clean up that balance sheet firstly, clean up the operations, and then probably just take a strategic lens to what's left. I'm hoping Ben can provide a bit more detail, but I think there was a really important announcement just a few weeks ago. We saw that share price we had just up there, that spike at the end. They've signed a deal with NatWest over in the UK. Now, they're a large bank over in the UK and potentially could be that first sign that this international segment, which has been burning 50, 60, 70 million dollars over the last few years per year, could be moving towards that break even. And of course, you just get that natural accretion at a group level when a loss-making segment gets to break even. So look, I said a buy last time. And even now go back to what I did back then and say, what am I paying for the Aussie business? 18, 19 times earnings, which is exceptionally cheap for, this sort of monopoly asset. It's diluted at a group level where you're paying, mid-30s, something like that. But if that international segment can get towards break even, which hopefully this NatWest deal is the start of that, then, this is one I expect to do quite well. So out of my small caps universe, I'm sort of micro cap focused, sort of sub 300-400 mil. This is 2.8 billion. But this is the sort of thing I think, investors who want a bit more security should be looking for. You've got real defensive downside here from that wonderful Aussie business. And it looks like that upside from the UK could be coming through. So I'll say a buy again and look forward to Ben's analysis.
Oh, I should have taken the hint, started with Ben. I actually did know that you guys own this. So would you be crystallizing some of the profits that you made, or is it still blue sky from here?
Yeah, well, as you mentioned, like we have discussed it before, and Luke Larrative and I have kind of talked about it at various times on the show. And our thesis was always quite consistent, which is that the business actually floated in 2021 at about $17 and then traded down due to kind of a combination of, the UK rollout disappointing and burning through a bit more cash than people were expecting. Australian property volumes were down in that kind of 22, 23 period. People kind of waiting for more clarity on what rates are doing and trying to wait for a better time to sell, which PEXA is exposed to volumes. And so that kind of confluence of negativity resulted in it trading around that $12, $10 to $15 range, but kind of stagnant around that $12 region for a while. Now, if you look at analyst reports, they kind of valued the Australian business, as Luke just kind of touched on, at about $15 to $16, and then the market was kind of marking it down based off the losses of the UK, kind of projected to not go anywhere and not make any progress. Our thesis was that the green shoots were there, that they were kind of getting some traction in the UK. Market wasn't really paying anything for it, and was still penalising it. So we've actually owned this at various weights for the last couple of years. Really good to see that kind of latest NatWest announcement. But just kind of rattling off a few quick signs that we think were kind of indicators that this might have been coming. In May last year, they announced their remortgaging solution, PEXA and NatWest collaborating. So typically PEXA kind of gets this remortgaging solution as a foot in the door and then upsells them into the full sale and purchase, which is just your regular property transactions, which is kind of twice the profit for PEXA. And in June, they kind of said they were continuing these onboarding discussions. In November, they said other UK banks were trialling the remortgaging solution as well. Then in February, they've come out and said that they've verbally agreed for the sale and purchase. April, it got regulatory approved, and then July, we've had the formal commitment from NatWest. So it just takes time, I think, is the key message. And sometimes, doing the work and being patient can kind of lead to that outperformance, but it may not necessarily be within that next few months when you think it's going to happen, particularly in this space where it's so heavily scrutinized from a regulatory standpoint. You're dealing with banks, so you can imagine that everything just takes time. Fundamentally, our views haven't changed. We think this is a good first step. I mean, NatWest is a big bank, bigger than CBA here in Australia. And we think that other banks might be kind of in the pipeline to follow now. And as Luke said, you've got new management, you've got kind of a refocus on strategy, what's the highest ROI for this business. So we can easily put some numbers together that say this is worth $20, $25 on that basis of continued traction in the UK. And we think that the recent strength on the back of that announcement is kind of some probably institutional buying back into this story, which have been pretty underweight and overweight kind of other property exposures. So it looks really interesting from our perspective and still own it. So I'd say it's a buy.
That is a buy for PEXA to start this Friday session. Let's get on to the next on the list, XRF Scientific. I'll go with you first on this one, Luke.
Start again. This is one, I think Ben owns this one as well, and disclosure, we own it in the Merewether Fund. One we've owned since the inception, and one I've owned personally even before that for many, many years. Been a fantastic business. These guys, they're sort of picks and shovels to mining assay testing samples. Really well run, and I think sort of what gets lost on this business a little bit through the noise, because inherently the market views mining services with a broad stroke as being capital intensive cyclical businesses, and certainly there's an element of XRF that is cyclical, but they run the razor blades model. So they sell equipment into laboratories, and then a consumable segment that comes in behind that, and they're dominant globally with that consumable segment and generate mid 30% profit before tax margins, which are the sort of margins you just wouldn't normally see in a mining services business. It's much more of an industrial from that point of view. Exceptionally well run, clean balance sheet, very conservative management. I think the market sort of, it's shorter term, that's a beautiful long-term chart. In the shorter term, you see some volatility in the share price. I think, again, the market sometimes misunderstands from a top-line revenue point of view. This business can move around a little bit. It depends on sort of the revenue mix of between their segments, and also the input prices to those consumable segments. The key inputs lithium, and with the lithium price coming off, XRF basically passed on the cheaper cost of goods to their customers and maintained, as I said, that sort of mid 30% profit before tax margin. I think as a business, it's historically given you sort of, low double-digit, high single-digit revenue growth, seen some good margin expansion behind that. I think they can continue that, and sort of maybe what gets a little bit, again, underestimated by the market is the ability for these guys to bolt on small acquisitions. They've made a couple in the last, 2 or 3 years. Really haven't contributed too much. Very small. Both businesses only contributing, a few $1 million a year revenue compared to XRF, will do maybe around 60 mil this year. But it's more XRF, global distribution base, global footprint, being able to take a small little bolt-on acquisition and flesh that out, which hopefully we see that come through over the next couple of years. So optically, look, it's not cheap. Probably trades on, somewhere in the mid 20s price to earnings. That is expensive if you view this through the lens of cyclical mining services. But as I said before, it's probably not really how I view this business. There is cyclicality to it. I always have to remind myself of that. But I view this more as an industrial style business, and that steady growth, that execution, it's one that I've been happy to hold for a while. And getting some good read through from some customers like ALQ and some of the sample testing labs as well. So I'll say positive, Nadine. I'll say a buy. Coming into results, maybe just keep your position small, wait and see what the result looks like. But this is one I've held for a while. Happy to keep holding, as long as I can into the foreseeable future. Really, really like this one.
Okay. Are you as positive on this one, Ben Richardson? And would you strategically play it differently heading into the result?
Largely 100% agree with all Luke's analysis there. We like it. We own it as well. I think for us, the key is that it did get sold off in the short term to about $1.60 or so. We kind of upweighted this in our portfolio. So it's now one of our larger positions, and think that it was just a completely misinterpreted weak quarterly update for the March quarter. And as Luke mentioned, there's a few moving parts in here, like the lithium price and timing issues and a few things like that, which can make any given quarter look slightly softer or weaker, particularly from a revenue standpoint. But the bottom line here is that the profit growth has been really consistent for this business. And given its size and liquidity profile, although Luke and I are both talking about it and have been, talking about it for a few years now, I think it's still really miscategorized by a lot of institutional investors. Like you talk to analysts at fund managers and brokers, and they're still comping it to NRW and McMahon and all these contractors, which, go hand to mouth to get the next contract. But it's a completely different business. It's, as Luke said, it's the razor and blades. So you're really exposed to more recurring revenue and I suppose sample volumes and things like that, rather than any given mine going well or poorly affecting your quarterly update. So I still have strong conviction that it's kind of misunderstood out there in the market, and hence why it kind of can bounce around a little bit, but the longer term trend has still been quite positive. So I think the key for us is that going into reporting season, if you look at ALS, which is one of the large lab groups that XRF actually sells its equipment and consumables into, ALS has reported a really strong equivalent Q4 period, which would be Q4 for XRF, and into the start of 26. So I think we will see some of those sample volumes revert higher, which is good news for XRF. That's the most profitable division, so they've got the best market share. And yeah, I think some of those little acquisitions are kind of the cherry on top, plug into an established distribution network, which has good customer trust and all those kind of things we look for, good management, etc.
Okay.
And
buy holders out.
Value for us. Buy.
Okay, great. Thanks. We're on number 3, and it is Red Hill Minerals. Ben, I'll start with you on this one. RHI.
Yep, it's another one which we think is pretty under the radar. I'm not sure if maybe you've been on the call once or twice before. Yeah. But basically, these guys were the original vendor of the MinRes Onslow Iron Ore project, which is been all over the headlines because MinRes has $5 billion of net debt. They need to get this project humming to de-lever and avoid a capital raise. And where Red Hill comes in is when they vended that project, that ground in the Pilbara, they retained a 0.75% royalty over that. And now MinRes is ramping it up from 0 to 35 million tonnes per annum, which means Red Hill is going to start printing 30 million per annum of free cash flow, which on the current enterprise value basis puts it on about 5 times cash flow. Now that's way too cheap on it for us. It's royalties companies trade on 10 times at least. These guys are proven fully franked dividend payers, and good royalties don't really last in public companies for long. So we think potentially there's a strategic interest angle as well. So under the radar, pretty illiquid, but well worth a spot on your watch list. Buy.
It's a buy. Now I know this isn't your style, Luke, necessarily, but what do you think about Red Hill Minerals when you look at it?
Yeah, I know I always say Nadine, a bit of a tourist when the resources picks come up. But look, this was super interesting, and I suspected it might have been a Seneca holding. 220 mil market cap, 64 mil cash. Board and management own 43% of the business. I wondered where I'd heard the name from, and of course, with MinRes in the news and Onslow, I'd obviously seen the name Red Hill floated around a few times, given that royalty, they're being tied to production. Look, I don't have anything to really poke a hole in here. It's not my space. I'm not out there looking at these businesses every day. There may be, they're exploring some other tenements, maybe with the goal to sell them off and retain a royalty similar to what they did with Onslow. So I'm not quite sure of the longer term strategy, but everything I saw, I don't have a problem with. Look, I would say a hold, but I'll actually continue the, Friday night, the Friday lunchtime good vibes, and I'll say a buy as well, because, if you're going to play in this space, this is the sort of thing I would look for. The balance sheet's rock solid, management own a ton, and I think you've got good upside, obviously leverage to that MinRes production coming online, and I'm fairly certain they had a good quarterly production update just the other day with Onslow run rating. So I was pleasantly surprised looking at this one for the first time, and let's say buy as well and send it to the committee.
It is a buy. The committee will take a look. Let's get to the next on the list. That is AIC Mines. I'll start with Ben, then I'll go to Luke.
Yeah, I think this is hopefully the last mining stock on the list for Luke there. But yeah, we like AIC as well. It's a copper producer in northwest Queensland. It's run by a guy called Aaron Colleran, who came out of Evolution, EVN, did BD there, corporate development. So good pedigree of people at AIC. It's copper, so anything that's had the name copper in it has been going well. You look at your Sandfires, Develop, Sandfires in Botswana and Spain, so it's hardly a tier 1 jurisdiction operator anymore. Develop has doubled over the last 12 months and trades 7 times EBITDA. AIC is on 2.5 times. AIC is growing its copper production from 12,500 tonnes per annum to 20,000 tonnes per annum. So it's probably the best growth in the sector at the cheapest valuation. And they've just done a few things, financing and off-takes and that kind of stuff that you need to bed down. It's not super exciting for the market, but it's really important to kind of underpin that next level of production growth. Even at current copper prices, this is making good money. We think copper has a bit of upside, even despite all this tariff noise. And it's just one that we think is a really solid kind of growth story in this space.
Okay, so that is a buy. We are on quite the roll, aren't we, guys? Luke, have you seen it any differently? Or are you happy to follow Luke's lead on this one?
I sort of am happy to follow it again, Nadine. I mean, we get a lot of resources suggestions on the call, and inevitably I think, investors, particularly when we talk about micro small caps, they want that explosive upside. So they're looking for explorers that are drilling holes, and you get that announcement that comes out and five X's on the day. I'd encourage investors though to look for this sort of stuff, and Ben's summing it up so well. Again, I don't playing it every day. So, but I come to it and I see 220 odd mil market cap, 60 mil cash. They've got a operating mine generating, call it 25, 26 mil free cash flow a year. As Ben pointed out, and I was hoping you'd go first to him for a bit of extra detail, but taking some of that cash and exploring and looking to build out those reserves and things like that. But again, this just looks like another well-run miner. I don't have a great view on copper. I know some others do, and I don't have a bearish view. I just don't really have one at all, to be honest. But as we sit here today, to Ben's point, it seems to be a cash flow positive business on where copper is today. You obviously get upside if you think that the commodity goes higher. But as I said, this is the sort of stuff I'm encouraging people to look for rather than the speculative people drilling a hole in the ground. So. Look, let's say a buy. We'll go with it. I think Ben's sold me again. This is the sort of stuff that I think is just much easier for you people looking for small cap exposure to these sorts of resources.
There we go. So that's a buy?
Yeah, keep the good times going.
All right, let's get to Vizarn, VYSARN. VYS is the ticker code. This one is for you to start, Luke.
Yeah, and spoiler, I'll have another buy in five in a row. I think that's a record for me. Own this one with Merewether Capital, so disclosure there.
Yeah.
Recently had an update, and it's one I've spoken about before. I think I had it as a Ausbiz Christmas cracker maybe a couple of years ago. Yeah, I'll have to go back and find that.
I was just looking at some of those old ones from a few years ago. Good fun. Anyways, continue on. We'll do it again this year.
Yeah, no, I'm sure I did. So these guys, it's a diversified water services business. Really interesting. I'll try and keep the history, brief here, but essentially it came out of nowhere maybe 5-6 years ago by acquiring some dewatering rigs from the old Ausdrill. Very capital-intensive, cyclical business. You're dewatering for mines, primarily tier one, sort of iron ore as they drill lower and lower under the water table. But the view was always to take the cash flow from that, pretty ugly, for lack of a better word, dewatering segment, and reinvest into more capital-light, technology-driven areas in that diversified water services space. And the business has just executed brilliantly. Like I've owned it for a few years now, followed it for many years as well, and they've done exactly what they've said, built up some segments organically, made some nice bolt-on acquisitions, had an update the other day which was pretty good. It was sort of in line with what I was expecting. Obviously share prices sort of run into that. But this is a business that now is getting to be a decent size for me anyway. 270 mil market cap, and made a large acquisition of a consulting business, I believe based out of Melbourne, but focused primarily along the East Coast. So the business is now going through, I guess, for lack of a better word, some teething issues with that. They called out slower than expected integration. And so they need to sort of bed that down. But the rest of the business is doing well. And I've pointed out a few times when I talk about Vizarn, the blue sky here, and no doubt some of it's in the price. I've tried not to factor it in too much to my valuations, but it is a little bit in the price, is they're looking to launch an asset management arm, which is effectively, something similar to what we have on the East Coast with the Murray-Darling system, but over in the Pilbara, which is, owning, tolling, controlling water in junction with the native titles. They've got 50-50 joint ventures with native title corporations. That's all very nascent. They're sort of ticking boxes along the approval process. There's some headlines with, disputes with Northern Star and the De Grey Hemi mine about the water and stuff there. That's still developing, but as they tick those boxes, it is more and more coming into the price. For me, I've got it on about 19 times earnings, which, as I said, it's probably a touch bit steep for what the business is today. You're looking at, maybe a year or two out and factoring a bit of that blue sky. But go back to what I said about XRF. I mean, you're backing a management team that's executed brilliantly over the last 3-4 years, and everything they've said they've done. That strategy's so clear. It's so, that they communicate it well to the market. So this is one that happy to hold, hopefully for the next 2-3 years, foreseeable future. And I'll say buy again.
Buy. Now, do you know Vizarn intricately, Ben, or are you going to follow the leader on this one as well?
Well, yeah, I do think that's a great summary there from Luke. I would say I've got a few thoughts on it from a Seneca perspective, which is that the core driver, which I think has really seen the earnings strongly grow, and the multiple re-rate for Visan is this core dewatering drill rigs, which management's done a fantastic job of executing. They've had some good projects and good tailwinds there. It is cyclical, and hence why they've gone into this water consulting space and also the asset management. Asset management looks interesting. I would say the consulting space is probably a bit less attractive. You probably get a lower multiple, and you require more evidence that that's going to be integrated and perform well for the dilution of the kind of the core business. But it does reduce a bit of cyclicality, so can kind of see it from both ways. But probably, I think the money to make here is writing this up from 5 to 10 times earnings to 15 to 20 on a cyclical upswing on that dewatering activity. Which I think the tailwinds are still quite good there. You've got a lot of iron ore mines going under the water table. You've got all these gold mines coming online in the higher gold price environment. We think the better way to play this would be Aquarian, AQN, which is explosives for these wet environment mines. It's kind of similar kind of tailwind. But yeah, I think Visan, like even this result that it's run up into, I've heard a few people talking about how well they were going to report, which always makes me think it's probably in the price. And yeah, just probably a bit cautious here. I wouldn't be buying at today's prices. Maybe it's a hold, but yeah, I mean, the other thing to quickly mention is this asset management kind of free option. It's kind of a similar style of idea to what we talked about at the top with PEXA. Also another one, Neuron Pharmaceuticals. Both are kind of priced on one asset and you're getting the second or third one for free. So it's an type of idea that we like. Just the valuations run a bit too hard here for us. So it'd be probably taking profits or maybe a hold on this one.
Okay. Now, Luke, sort of right of reply, AQN, have you heard of that one in the space?
Yeah, Ben mentioned it last time we were on, and I flicked him a message afterwards, Nadine, and said I hadn't actually looked at it, and he sent me a bit of work that he'd done, and so I have taken a look at it, and I agree, it's a super interesting idea. Don't own, just for disclosure, but I see that thesis, and I like, as he said, not exact peer, obviously, to Visan, but similar sort of idea. These miners, particularly as they go below the water table, sort of need more assistance with dewatering and explosives and all that sort of stuff to get minerals out of the ground. So, yes, no, we're familiar with it.
Got it. Thank you. All right, guys, that brings us to the halfway mark. I'm just going to keep it really simple. Double buy for PEXA, double buy for XRF Scientific, double buy for Red Hill, double buy for AIC. Bit of a difference here, Vizarn. Look, 19 times earning, Luke acknowledges that it's run up a bit, but it's still a buy from him. Although Luke would be taking some profit or holding it right now, not putting fresh money in there. Look, we've just put a whole lot of work on the investment committee when they meet next month. So we just held the committee meeting. So we'll be bringing you that new episode come Monday. Keep an eye out for that. So far, the fund is up by close to 44% since its inception on the 1st of March, 2022. Keep sending those requests in to ausbiz.co/callpicks. We love a bit of context, whether or not you already own them, or if you're looking to get in, sometimes it can help the guys direct the conversation. Let's get to the next on the list, and that is Laser Bond and Lycopodium, Acro Formworks, Change Financial, and Race Oncology. But we will begin with Laser Bond. Ben, why don't you take it away for Laser Bond, LBL?
Yeah, really interesting little company. I know Luke's done a lot of work on it over the years, and viewers have probably heard it, and kind of the characteristics that are really interesting about this business. It's founder-led. It's got quite a strong, compelling product offering where they do surface engineering and repair and remodel, rework heavy machinery. So any bit of machinery that's, in a wind turbine gearbox or a drill rig or something that has heavy wear and tear, they take it into a laser bond shop and repair it with this surface engineering technology and make it a lot stronger than it was originally. So you get a lot of extended lifetime, of these bits of kit. So it makes a lot of sense for companies to do it. It's kind of a bit exposed to maybe the CapEx cycle where you're making good money, then you start to kind of look at your equipment and what needs replacing and repairing. But yeah, fundamentally, it's been quite a solid business until probably a year or 12 to 18 months ago. It kind of ran into a bit of a brick wall when it didn't report growth for the first time in a while, and investors kind of derated it and had some question marks. So we actually owned it a couple of years ago, sold it after, it looked like it was kind of going backwards a little bit, at least from a top line perspective, and it does have a bit of operating leverage. And it's kind of had another disappointing update, and it's definitely on the watch list of the kind of businesses that we do like. But yeah, it just got a little bit tricky there, and it's kind of fallen away to that 40 cents mark. And then more recently, it's had a really positive trading update showing that potentially it's back on track, profit growth, valuations undemanding, just given that it's sold off so heavily. And it's kind of back looking quite interesting. However, I wouldn't probably be chasing it to sort of 60, 70 cents without seeing maybe one more result, a bit of follow through. We also think there's a bit of risk that they've talked about this North American expansion, where they want to acquire a facility and probably need to raise capital to do that. Maybe that's been parked for now, but we think if the share price goes up, then they might kind of get a head full of steam on that one and go through with that. So there's a few moving parts here. It's not a super scalable business where we think it can double within the next 12 months, which you don't necessarily need all of them in your portfolio. But when there's downside risk as well, it's kind of not one that we can get as comfortable with. So I'd probably just be a cautious hold at the moment. But yeah, keen to hear Luke's thoughts on the latest update.
Luke, give us your thoughts, please.
That we had come up last time, and I do just have owned it for many years. I sort of summed it up well. It's a really good business. I won't rehash them, but all those characteristics he outlined, and I know I said it earlier with XRF, Nadine, like sometimes, you have to sometimes take a step back through consistent execution and remember these businesses inherently can be cyclical. And I think the bond has those inherent qualities when, the PE multiple got upwards of 25 times earnings at one point. So it's a rich multiple to pay, and you need that consistent execution, a bit of inherent. I mean, that's now in the share price. And the last trading update, as Ben said, was a positive one. And the reason I said hold guidance, and it was sort of like, well, let's wait and see. If they hit that guidance, and this could look really interesting. Now, they came in, above that guidance and strongly above, to the point where now, as Ben correctly pointed out, business like this does not mean the turnaround's complete. I can buy a stock like LaserBomb, but market reaction, as we saw there from the update in July, didn't surprise me at all. So, look, if you take that second half, and again, as I said, I necessarily wouldn't rush to do this, but if you look at the strength of that second half, you can make the argument it's trading on 11, 12 times earnings. If you sort of take that second half into FY26, that's too cheap for LaserBond and all those good characteristics Ben outlined. I'm not sure if I'm willing to do that. Probably need to wait for the full year results. Let's see what the management outlook sort of says, what their view is on FY26. And they struggle a little bit with visibility, which has hurt them in the past. But they have a feel for where the business is generally travelling. So look, I had a hold back then. I will upgrade that today. I'll say a buy. But I think Ben summed it up well. Like, I wouldn't necessarily rush to buy this straight away. I think you've had a good result. It's the signal that, maybe the depths of that turnaround, we've seen the back of that. Maybe don't rush to annualize it. Wait for that full year result. Wait for the outlook. But this is too cheap if that sort of second half trajectory is holding. I think it's again, another well-run sort of family business, and that historical market multiple has been sort of 16, 18 times, which I think is more fair for where it should be. So I have just held it, but if I didn't, this would be one that I probably would be looking to buy.
I'm going to put a